So we characterize the Royce opportunity strategy as a deep value strategy. Why do we do that? Well, valuation is really at the core of the discipline, is that they look for stocks that are cheap based on price to book and price to sales. Actually distinctively cheap, generally 25 to 30% cheaper than the overall market. That creates a portfolio that has a number of attributes. The first is it has high active share. So it regularly is 90 or above active share portfolio. The second is a distinctive portfolio has the opportunity for distinctive performance. And this strategy has a history of that. Over 70% of the rolling 5-year periods, the strategy has beaten the Russell 2000. We think that's a particularly relevant question because at Royce, we believe we are transitioning from a period where the small cap index, the asset class itself, gave you double-digit returns to a period where it's probably more likely to be single-digit. Let's look at opportunity strategy and how it is executed in those different environments. Well, the history is that the greatest spread on rolling 5-year basis that opportunity strategy has had has actually been in single-digit return environments for the Russell 2000. More precisely, when returns have been on a 5-year basis between 5 and 10% for the Russell, that has been actually the best spread period for the opportunity strategy. Why is that relevant now? Well, we think the most likely scenario for the next 5 years is that high single-digit return for small caps. And historically, that's been really good for this strategy. We think perhaps among the most underappreciated attributes of the Royce opportunity strategy is how well it has historically done in rising interest rate environments. So if you look at 1-year periods where the 10-year Treasury yield has risen over the course of that period, and you said, how did opportunity strategy do versus the small cap index? The striking result is over 90% of those periods, opportunity beat the Russell 2000. And by an average of over 1,100 basis points. So rising interest rate environments, if that's what an allocator thinks is coming, this strategy has historically done quite well. So a reasonable question may be, well, markets are at all-time highs. You probably are having a hard time finding attractive investments. Maybe this isn't the best time for this strategy. So that perspective, we think, reveals what we think is an enduring misunderstanding about the small cap market. So one of the things that we feel is perennially underappreciated about the small cap market is that cliche that it's not a stock market, it's a market of stocks. And what we mean by that is there is wide variation in both quality and valuation at all times, and that creates opportunity. If you look at the overall Russell 2000 and say, what are the bottom 3 deciles on valuation, using enterprise value to earnings before interest and taxes as the valuation metric? What you find is there's wide variation, that the bottom 3 deciles sell between a 28 to 57% discount to the overall market. The small cap market is so wide and diverse that while still maintaining the valuation discipline, the opportunity strategy is always finding interesting investment candidates.